Federal Reserve Chair Kevin Warsh speaks at the Jackson Hole Economic Policy Symposium this week. Every major central banker and economist on earth attends this annual gathering in Wyoming. What Warsh says at Jackson Hole will set the tone for monetary policy for the remainder of 2026. Jackson Hole has historically been where the most significant Federal Reserve policy signals are delivered. In 2022, Jerome Powell's Jackson Hole speech delivered the most hawkish signal in decades, and markets fell sharply immediately after. In 2024, Powell used Jackson Hole to signal the beginning of rate cuts. In 2026, Warsh faces a completely different and arguably more complex situation. The Fed meeting minutes released last week showed support for rate hikes among multiple members. The 30-year Treasury yield hit 5.34%, its highest since 2007. Against this backdrop, Warsh must communicate the Fed's thinking about whether rates go higher from here. The specific language markets will be dissecting in real time. If Warsh says inflation risks remain to the upside, rate hike probability surges immediately. If he says the current rate level is sufficiently restrictive, markets interpret this as no more hikes. If he says the Fed is data-dependent and monitoring developments, it's interpreted as uncertainty, which markets hate. Housing starts fell 13.5% in July. Compared to the previous year, the direct consequence of mortgage rates at near-decade highs. This is the human cost of tight monetary policy landing in the real economy. Warsh sees this data. He also sees inflation at 3.4%. Both are real. The speech tells you which one he prioritizes. What to do before the speech. If you have variable rate debt, the pre-Jackson Hole window is your last opportunity to lock into a fixed rate before Warsh potentially signals further hikes. High-yield savings accounts continue paying well in elevated rate environments. Your long-term index fund investments, leave them completely alone, regardless of what Warsh says.